The banking regulator RBI today released a new framework to crack the whip on audit lapses in commercial banks. The new framework covers divergence in asset classification detected during RBI's inspections, which has plagued the sector quite recently. My colleague Ashwin Mohan joins in now with more perspective. Ashwin, what are the key aspects of this framework?
Audit firms in India have perhaps come under the lens of the regulators more now than ever before. Now the RBI has stepped in because it's clearly not impressed with the quality of stat audits in commercial banks. It wants to improve the overall quality of audit and also ensure that there is greater transparency in the system, because the RBI believes that statutory auditors of commercial banks also have a role to play when it comes to financial stability. So what they've done is that they've released a new enforcement framework for auditors of banks, and this enforcement framework will cover divergence in asset classification and provisioning if it's detected during RBI inspections. There are lots of lapses that will be covered under this enforcement framework. So if there has been a misstatement by an auditor, if there has been a wrong certification by an auditor, if there has been a misconduct by an auditor, all these will now be covered by the new enforcement framework. Of course, audit firms will also get a chance to explain themselves. They will get a chance to defend themselves. And clearly, what we also understand is that as part of the entire adjudication process, there will first be a show cause notice that will be issued against auditors, and then the auditors will get 15 days to defend themselves or to file a reply. Any sort of quantum of enforcement action, that will depend purely on the materiality of lapses. So if it's a non-material lapse, then perhaps auditors will get away with just a warning. But if it's a material lapse, then the RBI, if it deems fit, can also bar such firms from undertaking audit assignments. Back to you.
Quite an intricate process. Many thanks, Ashwin, for giving us those details. In fact, let's get on Ashwin Parekh, Managing Partner at Ashwin Parekh Advisory Services, with his thoughts on the same. Mr. Parekh, good morning. Great having you with us on the show. Clearly, it seems like the RBI is not impressed with these statutory audits. So this is a move, the new action framework on bank auditors, to ensure more transparency. Was it the need of the hour, and how are you reading into this move?
Well, I mean, I must say that to begin with, I think the regulator is really taking measures in the right direction. You know, the quality of audits, basically, of the banking system, and both, I mean, public sector and private sector, we've been seeing that there has been a gradual sort of, decline, to the extent that the confidence seems to be of the stakeholders, seems to be sort of, shaking a little bit. And that's something that is reflected in this particular observation. Now, I must say that there are two sides, of the entire issue. If I look at private sector, banking companies, for instance, there you may find that the auditors do get, both, I mean, well compensated to begin with. And also, there is a certain element of sort of continuity, to the extent that most auditors will be there for 4 years. And they're not working in huge panels. I mean, there may be joint auditors, I mean, in some cases in private banks, but they don't work sort of, I mean, they can use their bandwidth and to really cover a good part of various aspects of the banking business. That's not true with public sector banks. In the case of public sector banking, there are limitations. You have now a large number of branches. You have separate compensation and appointment regulations associated with the branch auditors. All that gets compiled at the headquarters, I mean, at the head office level. And the auditors per se have to depend upon the audit conducted by these people at various regional offices and at branch offices. And then it gets compiled. So, I mean, one must admit that there are both the sides. One is there is a general acceptance that the quality itself has gradually been coming down. And second is the practical difficulties that the auditors face, and that's true particularly for the public sector banking companies. Those also need to be addressed. I mean, it's like one-sided. You say that you expect quality, but then you're keeping the inherent problems in the system, basically. I mean, right from the appointment of in the panel of chartered accountants and audit firms, the certified practicing audit firms, from there on to their compensation to, the kind of comfort that people should get at the head office level to compile, to make the compiled statements.
Sure. Mr. Parekh, but don't you think that in light of the increasing loan-related scams that we've been seeing of late, that has come to light with private and public sector banks, that with the massive pile-up of bad loans, etc., that the RBI now tightening the new noose was a step that was much need of the hour, and that these kind of stern punitive actions are really a call?
I mean, they are a call. There is certainly a need for it. And I think it's, as I said, it's a measure in the right direction. But let's also accept the fact that, you see, the general principle around which the entire profession functions, is that, let's say, the auditors rely on the statements or the financial statements given by the other, let's say, audit firms. They cannot doubt them. Now, this will be true for borrowers, for instance. I mean, the RBI can run after the auditors for the banking companies. But what about the auditors of the borrowers? I mean, they produce financial statements. The banks use them for determining the amount of credit, and then they actually give that credit. Fund siphoning happens from there on. So, I mean, we've seen, time and again that the borrower accounts and financial statements submitted to the banking system are far more unreliable. Now you're basing, the entire audit and evaluation on the basis of those financial statements, including, in fact, the credit and the flow of credit from the banking system. So I suppose both the aspects need to be tightened. In fact, there the quality perhaps one may find is really deteriorated quite substantially.
Thanks so much, Mr. Parekh, for joining in and giving us your assessment. So while you've explained both sides of the story, you believe that it is a move in the right direction.